Morning, ladies and gentlemen. Welcome to IGE Webinar today. I'm John Gwang-woo, Chairman of IGE. First of all, I would like to take this opportunity to wish you a very happy new year. I sincerely hope that you will successfully move beyond the pandemic crisis this year. Today, I'm very happy to have a distinguished speaker, Dr. Shaun Roach, who is joining us live from Singapore. Dr. Roach is one of the world's most respected experts on the economies of Asia Pacific. I'm confident that his informative and insightful views will help us better understand the likely trajectory of global and regional economic recovery this year and beyond. Dr. Roach has excellent credentials, including a long career at IMF, where he was IMF resident representative in Hong Kong, and a key contributor to the flagship Global Financial Stability Report. In addition to his professional accomplishments, he holds a PhD in economics from University of London, and he is currently chief economist of S&P Global Ratings Asia Pacific. But before we get started, one quick housekeeping note is that the viewers may send their questions for our speaker through chatting room. I will be happy to look at those questions and raise those with in due course. Without further ado, let's welcome Dr. Roach, who will speak for about 30 to 40 minutes, followed by our Q&As until 10 a.m. In Seoul time as scheduled. Dr. Roach, on.
Thank you, Dr. June. Thank you again for inviting me to participate in an IGE event. I always find these events exceptionally interesting and helpful. I learn a lot from my professional Korean economist colleagues, particularly about Korea and the way Asia Pacific is managing some of the challenges that it's facing. So a tremendous privilege once again to be able to speak to you all. And Happy New Year. Again, as Dr. June suggested, let's hope that this year is better than last. And I think certainly we think it should be. I'm going to try and share some slides, but let me start first of all, while that's being fixed, by giving you a broad sense of how we're seeing the world in 2021. So we're looking for a recovery. We do think the recovery has been delayed, but not derailed by the upsurge in the infection that we've seen over recent weeks and months in the US and Europe. But global financial conditions are going to remain very supportive, we think, for the global economy, and the amount of stimulus that we see in the system, combined of course with the vaccine, should ensure that we continue to see a normalization in activity, particularly in the second half of this year, that will allow growth outcomes to be far better than they were clearly in 2020, and I think perhaps a little bit better than many people expect. At least for the first half of this year, manufacturing and trade are going to continue to lead the economy, as they've done since the first stages of China's recovery in the second quarter of last year. We're going to have to wait for a little bit longer before services start to contribute more to GDP growth. Asia is going to continue to lead the global recovery in terms of growth, but Asia is leading more in terms of supply than demand, and that's a very important point to remember when you're thinking about where is the growth coming from and what does that growth look like. In terms of demand, it's mainly going to come from, at least in the next month or two, from the US and Europe. Over time, we hope to see demand in Asia pick up, but so far demand in Asia has been weaker perhaps than we might have expected. China's recovery is for real, but it's unbalanced, and we'll show you why that's true later. Korea's recovery, we think, is going to be pretty impressive this year. We're looking for growth of about 3.6%, but it will be critical for the labor market, for jobs to come back faster than they have done, certainly over the last couple of months, as the COVID resurgence maybe has slowed hiring a little bit. And then finally, we'll talk about strategic trade policy. There's going to be some very big moves this year that are going to define what Asia Pacific's trade network looks like over the next decade. Network and scale effects are going to be incredibly important, and here China has a huge advantage. Before we get into the details, just to give you a sense of our global economic growth forecasts, here they are on this slide. I won't go through them in great detail, but just a couple of highlights. We expect global growth of about 4% this year. In the US, we expect the economy to be back at pre-COVID levels in the third quarter of 2021. If Biden comes up with a bigger stimulus, perhaps something close to $1.5 trillion compared to the $1 trillion we currently assume, and that looks likely, we could see growth higher this year for the US and the economy getting back to pre-COVID levels in the second quarter of this year. So there are upside risks to our US growth forecast at the moment. Elsewhere, you'll see that Asia Pacific generally leads the recovery in terms of growth rates. China, we expect to grow at 7% this year. We think that's going to be a little bit lower than other people are expecting. I'll explain why later, but it mainly comes down to tight policies in China. And the other one I think is worth looking at the moment is India, where people got very pessimistic, but now we actually see a better outcome in India over this fiscal year and going into next fiscal year. And we continue to see the economy growing at 10% in fiscal year 2021. Okay, so let's step back. Where are we in terms of the pandemic? Our assumption for some time has been that a vaccine will be broadly distributed to at least the major economies of the world in the second half of 2021. Right now, there are upside risks to that view because clearly the vaccine is already being distributed, although it's not being widely distributed across all of the major economies. But this is coming clearly in a backdrop in which the COVID reinfections are surging again. This chart shows mobility, how much people are moving around in different economies compared to pre-pandemic levels. So this is data we get from mobile phones. When the line is below 0, it's telling you how far below pre-pandemic levels that mobility is. And this is mobility at stores, parks, museums, and other entertainment venues. And you can see that we're not going back to where we were in the second quarter of 2020, where mobility fell to 75% below normal levels, but we have seen some setbacks. In the US and Europe and emerging markets outside of Asia, we have seen mobility again fall to 40% below normal levels after improving during the second half of last year. We think this is temporary. We expect it to last maybe for a month. It means that the first quarter growth numbers may be disappointing, but going into Q2, Q3, particularly as the vaccine is rolled out, we would expect that normalization to start again. But the other thing you'll notice, of course, is how well Asia has done. So the light blue line shows mobility in the Asia-Pacific developed economies. Here we're including Japan, Korea, Australia, and New Zealand. And you can see that clearly these economies have outperformed in their management of COVID. People are moving around more than they are in other places. But at the same time, you can see that we've stalled at about 10% below normal levels. So even in the best performing economies of the world in terms of managing COVID, we're still in what we would call a 90% economy. That's not going to change until the vaccine is rolled out. The good news, though, for Asia Pacific is that management of the pandemic is showing up in a much better performance of the labor market. This shows rebased employment across the world since COVID. So we've rebased it at 100 in December of 2019. And you can see that in Asia Pacific, employment never fell by much more than 5% and has recovered a little bit since then. If you look at the US, employment fell by 15% and now looks to be slowing a little bit as COVID resurgence has returned. We do expect the US labor market to continue improving as we go through this year, but for now, you can see the gap between Asia and the rest of the world in terms of employment. The other interesting point about this chart, and this is important for Europe, is even though European COVID management has also been difficult, you can see that the impact on the labor market has been lower than in the US. And this is a direct result of those big wage subsidy job support programs we saw in Europe. They have worked. So labor market damage in Europe has been much more limited, and we think that's a good sign for European growth for this year and next year. But at the same time, we are now facing a more difficult situation in Q1. And we had a downside scenario when we did our last forecasts, which was at the end of November last year. We thought, what would happen if COVID did re-emerge faster than most people were thinking? And what we would end up with is a W-shaped recovery. I think that's where we're going. So we're getting closer to our downside scenarios now, as you can see from these two charts on the left-hand side for the US, on the right-hand side for Germany, as an example from Europe. But the good news is that because of the amount of policy stimulus that's already in the system and the fact that the vaccines are rolling out, this now is a temporary shock. So we do expect activity levels, the blue line here for both the US and Germany, we do expect those blue lines to go back up to where they would have been even if we hadn't had these second and third COVID waves. So this is a temporary shock. It means temporary lower growth in Q1, perhaps a little bit in Q2, but I don't think it really makes a huge difference for where the economy is going to end up in 2022 or 2023. So that's the good news. One really important reason why we don't think that the recent COVID resurgence is going to have a huge impact, and this is also very important for Asia Pacific this year, and that is financial conditions. Financial conditions, particularly in the United States, remain exceptionally supportive, and we think they will remain supportive all the way through this year. There's been a lot of talk at the moment about rising US bond yields, and that is something to watch. And clearly the Fed will calibrate policies as we go down the road based on how much fiscal policy stimulus we get. But think about why US bond yields are going up. The top two charts explain why. On the left-hand side, you can see the real US 10-year yield. So this is the real yield taking away the impact of inflation. And you can see that markets are pricing in a real yield that is pretty much unchanged and at cyclical lows at about -1% over the next 10 years. The rise in US bond yields is coming for good reasons. And the good reason is the market is pricing in higher inflation. In fact, the market is now expecting that the Fed is going to meet its own inflation target over the next 10 years. So you can see on the right-hand side, break-even inflation for the US economy now is at 2%, in line with the Fed's target. So the Fed's new policy of committing to keep rates lower, to average inflation over the cycle, has worked in terms of convincing markets that inflation can rise back up to its target. And that is a good development. So in some sense, the rise in US bond yields is a reflation signal, and that is a good signal for the economy, and it's a signal that monetary policy is working. On the bottom two charts, the other sort of conditions that we would look at, of course, is implied equity volatility. That's still higher than average, but it's come down significantly. And on the right-hand side, you can see the Federal Reserve's own measure of financial conditions across the entire economy. And at the moment, they are remaining very supportive and we expect them to continue to remain supportive. So if, for example, we saw rising US bond yields lead to wider credit spreads in the US markets, we think the Fed would come in and try to restrain that financial conditions tightening. Ultimately, we don't think the Fed is going to be raising rates until 2024. That would be consistent with their current thinking in terms of averaging inflation over the cycle. It's going to take a long time, we think, before inflation sustainably stays above 2%, and that's going to require unemployment to come down quite significantly. So Asia Pacific is leading this recovery. That's the good news. On the left-hand side, you can see industrial production growth for Asia Pacific, excluding China. So this is being driven mainly by Japan and Korea and Taiwan to a large extent. You can see China, and then you can see the G20 advanced economies. So this is basically US and Europe. And you can see the extent to which a lot of the concerns we had about industrial supply chains were misplaced. The industrial sector has come back much quicker, I think, than people thought. And Asia Pacific is leading that recovery. So already we're starting to see positive industrial sector growth across Asia Pacific, and clearly that's being led by China. But while Asia Pacific is leading on the supply side, it is not leading on the demand side of the economy, particularly consumer demand. So if you look at the right-hand side chart, again for China, Asia Pacific excluding China, and the G20 advanced economies, you can see the extent to which Asia Pacific is lagging in terms of consumer demand. Retail sales growth is still negative and actually has started to flatten out as we've got those mini second and third waves in Japan and Korea and some other parts of Asia Pacific over recent months. So clearly something else needs to be done to get consumers to spend more in Asia Pacific. It's not really coming through at the moment, which is kind of surprising given the extent to which employment markets have been much more resilient in the region than they've been elsewhere. I think policy stimulus is playing a big role here. Clearly, policy stimulus in Europe and the US is directly targeted at households, and that's having a big effect. I'll talk a little bit more about China and retail sales later, but that's a very important story too. Now, this weakness in demand in Asia Pacific compared to what you might think would be happening given how well Asia Pacific has managed the pandemic is showing up in the current account. So on the left-hand side, you can see the current account balances for Asia Pacific, including China, Europe, and the US. The light blue line shows Asia Pacific. The current account surplus in Asia has actually risen from about 1% of GDP in late 2019 to over 3% of GDP in the third quarter of last year. What that is telling you is that relative to the rest of the world, Asia Pacific is saving more and investing less. So this is a bit of a puzzle. And if you look on the right-hand side, this is happening across all of our economies. So it's happening in China. It's clearly happening in Northeast Asia, which is Japan, Korea, and Taiwan. And it's also happening in our emerging markets, including India and Indonesia. So all of Asia Pacific is seeing a big rise in current account surpluses. And this might explain to some extent some of the upward pressure that we're seeing on currencies versus the dollar across the region. Now, of course, one of the reasons for the rise in the current account surplus is simply the fact that exports have done incredibly well. This chart shows the export performance of Asia Pacific and Asia Pacific excluding China. And here we take away mineral fuels because we don't want to be influenced by the oil price. And you can see exports are booming. Exports are now back above pre-COVID levels. They're back above trade war levels. In fact, they're at record highs. So what's going on? Well, as the rest of the world has gone into lockdown, consumers have stayed at home. Actually, their incomes have not suffered as much as maybe you might think because of all of this policy stimulus, including wage subsidies and higher unemployment benefits in the US and Europe. And consumers have switched from spending on services, restaurant meals, vacations, to goods. and that is benefiting Asian exporters. Of course, the other reasons would be work from home electronics, as people spend more time at home, and also medical equipment. But all of these factors have led to an export boom in Asia Pacific. So the key question for this year is this going to continue? It's likely that we're going to see some slowdown in some of the spending by consumers in the rest of the world on goods as we go through this year relative to services. So as economies open up, consumers in the US and Europe are likely to spend less on new TVs and computers, but spend more on going out again, maybe spend more on vacations. So we are going to see some slowdown, perhaps in those parts of exports. But it's likely for us that we're going to see capital goods demand rise. So this chart shows the rebased performance of Asia Pacific exports by product category since 2019. And you can see the big rise is really in the light blue and the yellow lines. So this is office equipment and computers, and electrical machinery, which mainly is actually semiconductors. So these are the two components of exports that have risen so much. As we go through this year, we're going to have to see more demand from companies for capital goods. That here would be the pink line, other machinery and equipment. It has been capital equipment that typically drives the Asia export cycle, and we're going to need to see that coming through later this year. We think it will happen as economies open up and firms start looking then at their investment spending plans. We do expect capital spending to rise, but there is a risk. And this is a risk that's been highlighted by our colleagues in the US and Europe on the rating side. They look at corporate sector balance sheets and they have worsened. There is no doubt there is more debt on balance sheets now, and it may take time for companies to manage that higher debt, to clean up their balance sheets after a difficult period last year. And so capital spending might be weaker than it otherwise would be. On balance, we do expect capital spending to rise, and that's going to be consistent with this broad economic recovery. But it's not going to come everywhere. This corporate sector debt is, I think, a risk to that outlook for this year. So overall, a reasonably good story for Asia. It is being driven mostly by exports at the moment, to some extent investment, but we are going to need to see retail sales and consumption come through to drive that recovery. But that really is only going to happen as vaccines get rolled out and as the service sector normalizes. Okay, let's talk quickly about China. Really, the key story on China is the economy is not as strong as the newspapers suggest that it is. These are the key macroeconomic indicators from China. And you can see from this chart, manufacturing production, the bars here show year-on-year growth over recent months. The yellow line shows the 5-year average growth rate for each of these indicators. Manufacturing production is back, growing slightly above average levels. The same is also true for exports. The same is true for property sales. So this is a recovery being driven by three things: infrastructure investment, the property sector, and exports. What is not driving the recovery is consumption. So if you look at retail sales in nominal terms, they are only growing at 5%. That sounds okay, but let's remember, if you look at the yellow line, retail sales growth in China was growing at 8% before COVID. So retail sales growth is not back to where it was. There has been no pent-up demand in China, and consumers have been saving much more than I think perhaps people had expected once the recovery began. So why is that? The key factor in China is that households suffered a quite large income shock in the first half of last year. So income grew only by about 1.5% to 2% for urban households. Those households had been used to income growing by about 8%. Unlike other economies, including Korea and Japan in our region and the US and in Europe, in China, fiscal policy didn't really directly help households that much. So if you look at transfers from the government to households, unemployment benefits, wage subsidies, other types of transfers, they remained unchanged. You saw a little bit of help, but not that much help. All of the stimulus went into infrastructure investment. And that's why Chinese consumers are a little bit cautious. They're holding back, they're saving more, and they're waiting for things to improve before they start spending again, because they didn't receive the income support from government that we've seen in other economies. And that is showing up in this growth path, which is a little bit unbalanced. And is one of the reasons why we think that we need to see the consumer come back in China much more this year for growth to get above 7%. Now, we do expect the recovery to continue. We do think the consumer is coming back. It's just going to take longer, I think, than people think. The other reason that's going to keep growth perhaps lower than other people think at the moment, at 7% for this year, is policy. Chinese policymakers have been very careful over the last year. They have not thrown a lot of stimulus at the economy. One way to look at this is financial conditions in China. This chart shows financial conditions, which is a measure of things like real interest rates, credit flows, activity in financial markets. Typically, when this line is high and rising, it is showing that more stimulus is going into the economy. And when it's falling and low, it means that the authorities are pulling stimulus away and are tightening policies. Now you can see that this has a cycle. As in China, we know very well, policy stimulus comes and goes very quickly. And that leads to the economy having a stop-go cycle. Now look at 2020. In May of 2020, just after COVID peaked in Wuhan and across the country, policy stimulus was very strong indeed. Financial conditions were at their easiest level since 2010. But since then, policies have tightened quite a bit. So real interest rates have gone up. We've seen credit flows fall. And we're also seeing some stresses in China's credit markets. So my credit colleagues have been writing a lot about some of the rising default risk that we're seeing among SOEs in China, for example. And we think that's going to continue through 2021. So what's going on? Well, we think China's government is still very focused on risk, and they want to make sure that risk remains controlled. But while they look to be successful on managing risk, it will have implications for growth. It does mean the economy will grow slower than it ordinarily would have done. These financial conditions typically lead growth by about 2 quarters. And so this tightening in financial conditions that we saw in the second half of last year, to us means that growth is going to continue recovering in the first half of next year, but it's not going to be as fast as financial markets expect. And overall, we think we're going to see growth of about 7% for this year, which is a good outcome for China, but perhaps not as much as maybe some people are hoping for. Let me just finish off on 2 other comments, and then maybe we can open it up for discussion with Dr. Jun. First of all, some comments on Korea. And I know I have a lot of Korea experts with us today. So I'll be brief and give you an outsider's view of how we see the economy at the moment and what the prospects are. Overall, we are optimistic on Korea. I think our forecast is towards the high end of the range. We've always been quite optimistic on Korea's economy through COVID, because we felt that the management of the pandemic has limited the damage to the economy, particularly in terms of corporate sector balance sheets and jobs. And that means the economy can rebound quicker and get back closer to that pre-COVID trend. In other economies where the damage is greater, we think the permanent effect on the economy is going to be larger. And Korea has managed to avoid that damage. But while that's true, there is still a long way to go before we get anywhere back to normal. And for us, one of the key factors driving the recovery is going to be jobs. Now in Korea, as we showed earlier, we only saw a decline in employment of about 5% from pre-COVID levels, which is much better than we've seen in other economies. The recovery has begun, but the recovery has a long way to go. And the other interesting thing about the loss in jobs is where those jobs were. So if you look on the left-hand side, this shows rebased employment in Korea since the end of 2018. All of the jobs lost during COVID in Korea were irregular jobs, temporary workers, part-time or self-employed workers. And of course, this is less true of Korea, but it's true in Japan and other economies, including Australia. A large part of the jobs growth in recent years has been in these areas. So I think this is explaining why consumption has been quite weak in parts of Asia Pacific, even though management of the pandemic has been quite impressive. A lot of the jobs being lost are those irregular jobs, and people do not have confidence. Even if those jobs come back, they don't know for how long they're going to have those jobs. Any shock could mean that they lose their jobs once again. And I think that's part of the reason why we're seeing households increase their saving, cut back their spending, just in case they start to see increased uncertainty in the future. The other thing about the left-hand side, although if you look at this chart, about half of the irregular job losses due to COVID have been recovered, and this is fantastic news. And we do think it's going to continue all the way through 2021, particularly as the service sector reopens. We should remember that even though it looks from here as though irregular jobs are only about 3% below pre-COVID levels, average hours worked are still 10% below where we were this time last year. So part-time and temporary jobs are coming back, but people are working fewer hours. And of course, that affects income and it affects confidence. And that's another reason why we are going to have to see that improve as we go through 2021 for households to feel more confident to spend more. The same is also true in Japan on the right-hand side. It really has been this part of the labor market that has suffered so much more. And of course, this is all related to the way that COVID hits economies. It's hitting the service sector, it's hitting personal services in particular, and this is where a lot of temporary and part-time jobs are. What this means for policies is, I think, quite interesting, because if you have a labor market where things are getting back to normal only very slowly, and people are holding back on spending, what you're going to end up with is low inflation. And core inflation in Korea remains significantly lower than the target. And it has been getting, the gap between core inflation and the BOK's target has been widening over the last 2 to 3 years. And that's a problem. It is having an effect, I think, on the Bank of Korea's own inflation target credibility. We've seen from the recent Bank of Korea household surveys that households now expect prices to be falling. So this is this deflationary mindset that becomes a bit of a risk, I think, for Korea. It's something I've spoken about for some time. And this chart here shows you why it's a risk for policy. The light blue line here is the real policy rate for Korea. It is the Bank of Korea's cash rate, and then we take away core inflation over the previous 12 months. And you can see that in previous cycles, the real policy rate has become significantly negative during downturns, whether it's the global financial crisis or during China's slowdown in 2015, 2016. The dark blue line here is the trend rate for the interest rate. So it's kind of where you would expect maybe the interest rate to be on average over the cycle. And you can see again, during previous downturns, the light blue line has come significantly below the dark blue line, telling you the Bank of Korea is pushing stimulus into the economy. That has not happened post-COVID. And the reason it hasn't happened is a couple of reasons. First of all, we're getting very close to zero. So it's getting hard, of course, for the Bank of Korea to cut too much further. The second reason is that inflation keeps falling, and that is putting upward pressure on the real interest rate. So in fact, the Bank of Korea, while it has cut rates this year, or last year, I should say, it's cut the cash rate to a record low of 0.5%. Monetary policy isn't that supportive. The good news, of course, in Korea is that the policy mix has changed. We've seen much more fiscal easing. Now, of course, that has implications for debt dynamics in the medium term, but at least when you're thinking about growth over the next 1 to 2 years and inflation, that has been an incredibly supportive policy mix, given that the Bank of Korea is unable to do much more in terms of its own conventional monetary policy. And of course, the Bank of Korea has also been reluctant to cut rates even from 50 basis points because it's concerned about the financial stability and particularly household borrowing growth. From our perspective, we would be much more worried about low inflation leading to persistent deflation, and we would look to other tools like macroprudential tools to manage financial stability risks. But clearly, it's a trade-off the Bank of Korea is going to continue facing, and we don't think the Bank of Korea will be cutting rates anymore this year. But at the same time, we also think that rate hikes are probably some way off, particularly if the Fed is only going to be moving, we think, in 2024. And then just finally, maybe the last 2 or 3 minutes on trade. When all of this ends, when COVID is behind us, we're going to start talking about trade once again. There's no doubt. The trade war, perhaps in the Trump era, has finished, but trade and geopolitical competition are only just starting. Let me just show you 2 diagrams, just to visualize what we think trade looks like now and to try and think about what it might look like in the coming decade. On the left-hand side, this shows the top 15 bilateral export relationships in Asia Pacific. So you see the country name is in the circle, the direction of the arrow shows you who's exporting to who, and the width of the arrow shows how big those exports are. And the key thing, if you look at Asia's trade relationship this is the total sum of exports between 2017 and 2019, is China is in the middle, right? It is the hub of Asia Pacific trade. Almost everything goes through China. And I think talk of decoupling and supply chain diversification has to deal with the fact that China is at the hub of regional trade and enjoys enormous economies of scale and network benefits that are very hard to overcome. So you might see some supply chains moving in certain industries, but I think lifting whole supply chains from China is going to take many, many years and could prove incredibly expensive. This is particularly true increasingly on the right-hand side, and this is for the semiconductor industry. Technically, this is the HS code 85, which includes most of the integrated circuits and semiconductor device products. And you can see here again, and this is, by the way, the export product that accounts for the highest value of Asian trade. China is in the middle. But look at the direction of arrows on the right-hand side, where for China. Most of the arrows are going into China. So China is not a big exporter of semiconductors. It is an importer of semiconductors, which it uses in its own processing. Okay, so a number of things are going to change over the next 10 years that could challenge that model on the right-hand side. The Regional Comprehensive Economic Partnership, RCEP, is going to open up new markets for China. It's going to open up new markets for all economies, but who can compete with the scale and network advantages that China faces? Who's going to be able to reduce their costs as much as China can across a whole range of highly differentiated goods? We're also going to have US re-engagement, we hope, in TPP. We think that's going to happen. We think the Biden administration is going to open up negotiations again on TPP, but that's probably only a story for 2022. And then finally, and perhaps most importantly, China's dual circulation policy. China is focusing on that trade network on the right. It is actively going to try and turn those arrows around. It is going to aim to become the biggest producer and exporter of what it considers supply chain critical technology over the next 10 to 15 years. And this is going to create a huge challenge for any economy and any company that is involved in this industry. It's going to come slowly, but it is going to come. And I think we're going to see a lot of government support, starting with the 5-year plan from China in March to try and support those aims. And just finally, that doesn't mean that China is closing up. Part of dual circulation is also opening up. So in areas where supply chain risks are lower, financial services, consumer discretionary goods like autos, we do think that China is going to continue to open up. We've seen that, for example, with the recent bilateral investment deal with Europe. And at the same time, we also expect to see a much bigger push on China's domestic demand. This chart shows China's economy by share of spending. Our baseline assumes that by 2040, private consumption as a share of China's GDP is going to rise from about 40% to 55%. And that means that investment spending in China is going to fall by about the same amount. So dual circulation doesn't just mean import substitution for technology, although that is a very important part of the plan. It also means rebalancing. It also means opening up in some areas of the economy where China feels its supply chain risks are manageable. So as we go through COVID and as economies get back to normal, I think trade, technology, and geopolitical competition are going to rise back to the top of the agenda. And I think we'll have to watch very carefully China's 5-year plan to see what this means for the rest of the region. So with that, I'll finish my remarks and hand it back to Dr. June.
Sean, for your brilliant opening presentation with full of information and intelligence, which will take time for us to digest. But it's a great start for our conversation today. Now, before I raise some questions reflecting on feedback from our viewers, I'm very delighted to have Professor Kim Dong-jae, who is online at the moment. He's at Yonsei University's Graduate School of International Studies. Professor Kim is widely known for his expertise, not only as an academic researcher, but also business practitioner. He was with McKinsey and Company before as well. Are you there, Professor Kim?
Yes, I'm here.
Okay. Well,
Thank
welcome.
you.
And I hope you raise some good and tough questions to Sean.
Well, thank you, Dr. Roach. Thank you for your sharing your thoughts. Well, given the big picture, actually have briefly touched upon during your presentation, but I'd like to get your perspective on the stock market. Are you also worried about what they call the widening gap between the stock market and the real economy? What do you think?
Thank you, Professor Kim. I hope someone wasn't going to ask that question, but I think it's an important one, so it doesn't surprise me that you have. The way we think about this is central banks had run out of policy space, effectively, conventional policy space. I mean, policy rates were close to the lower band. The US and UK clearly don't want negative rates, neither does Australia. I think Japan is as low as it wants to go. Europe is exploring a little bit more, but even there, most of the action now is on balance sheets. And I think central banks realize that one of the ways that they can influence financial conditions and support growth when they can't do too much on short-term interest rates is by compressing financial risk premium. I think that's part of the rationale for QE. So I think the Fed in particular has led the way on this in the last 12 months by directly intervening in the corporate bond market. So we've been following this very closely, of course. It's really important for our issuers. But as soon as the Fed committed to buy corporate debt, including speculative grade debt, we saw spreads collapse, absolutely collapse. And so before the Fed even started buying, the market rallied. And then the Fed actually probably didn't need to start buying, but they followed through anyway, just to show that they were serious. And we've seen, even in recent days and weeks, speculative grade spreads tighten to the lowest levels we've seen for decades. I think they're even record lows right now. So in a way, this is exactly what central banks wanted to happen. If they've run out of other tools, this is one way you can support the economy. You can support bond issuance, which has been at record levels, of course, in the US. You can support credit growth. It does have side effects, though. And the side effect is clearly evident, I think, in the stock market, but not just the stock market. It is evident in all sorts of credit spreads at the moment, other types of risk premium that we're seeing. And I think the challenge now is, what do central banks do about that? I think what we're learning is that central banks are willing to take that risk. I think they feel that compressing financial risk premium to support activity is a price worth paying. There is going to be a period, though, where those risk premium start to decompress again. And we're already starting to, I think, to hear from central bankers that might be at the forefront of their minds. What does that mean? Policy tightening? We don't think it means policy tightening. So in the meantime, there's not an awful lot that central bankers can do. They can tell us they're concerned, but they're not going to change their policies. So we're left with this predicament. I think where we would get worried is if this shows up on balance sheets. So long as it's Bitcoin and its equity markets, then when it falls, it's going to be painful for some people. But if it doesn't show up in credit and leverage and balance sheet stress, then we as a rating agency don't get concerned. But if we start to see some of this speculation show up on balance sheets in the corporate sector, in the financial system, then we get concerned. Right now, we're not that concerned. We see some pockets of stress, some pockets of vulnerability, but overall, we're not raising the alarm bells just yet. But I think, if that were to change as we go through this year, central banks would start to take it much more seriously. So, Professor Kim, it's not a great answer. It is a worry. I think there is this big gap. But for now, central banks seem willing to pay that price and take that risk.
Professor Kim, was that satisfactory? Any comment or response?
Yeah, from a big picture standpoint. Yeah.
Go ahead.
Okay.
Professor Kim. Yeah.
Do I continue, or some other people with questions?
Sorry. Go ahead, Professor Kim.
Do I continue, or
more follow-up question if you like?
Well, okay. Just one more question, Dr. Roach. About what do you think about this? This may sound different, but I think it's all related. The income inequality. What's your perspective? The underlying, you're talking about economy, but economy is all related to politics and people's lives. And stock market, for example, is symbolic in the sense that it signals widening income inequality. So I think, what's your perspective on that?
Yeah, no, Professor Kim, I think that is a huge issue in almost every economy that I look at in Asia Pacific, including China, by the way, but also the US and Western Europe. And I think central bankers have been at the forefront of trying to, as best they can, because they never want to go too political, explain that, look, if you ask central banks to do too much, we're going to be worsening inequality, because you know what benefits most? Equity prices and house prices. I mean, the other thing that we can see from the COVID era is house prices almost everywhere are doing fantastically well, whether it's the US, Europe, China, Australia, Korea. Well, I know, house prices have been quite buoyant. And it's a side effect of this exceptional monetary policy easing. So central bankers have been saying, look, to fiscal policymakers, you guys have to sort this out and come up with a solution about, first of all, taking some of the burden away from central banks and then finding a policy solution for this. I don't think the thinking has really started yet, if I'm honest. A lot of what we've seen is temporary fixes, but when we come out of this, the inequality is going to be worse. And I haven't seen any major economy come up so far with a solution for it. So I think it's going to be a #1 question at top of people's minds. And it's going to be even more important when people say, where did all the stimulus money go? You know, I'm still back in my job. I'm getting paid minimum wage. You know, I still can't afford a house. Where did all this stimulus money go? I didn't see it, or I saw a very small part of it. And there's going to be a lot of political pressure. So we're going to need to see that debate start soon. We'll see what happens with the new US administration. But so far, I think a lot of this has been a temporary fix. Things have gotten worse, and we're going to need to see some progress. So no, I agree. That big picture is, along with trade, going to be top of the sort of geopolitical economic agenda for the next couple of years.
Okay, thank you, Professor Kim.
Thank you, thank you, Dr. Roach.
If you want, you will be excused now.
Thanks.
Now, for the rest of about 10 minutes, up to 10 minutes, I would like to have some conversation with Sean on several questions that have been raised from our viewers. Now, before I do that, perhaps I may sort of recap what Sean has just said. In ways, there are some takeaways that I can see. First is the global growth. Now, you're talking about 4% this year, which is pretty much in line with World Bank latest forecast. With W-shape recovery kind of trajectory that I talked about. That's perhaps relatively lower than some other predictions made by other organizations. Second, on US, you are a little bit on the high side. S&P is on the high side. We're talking about 3 to 4% growth, thanks to the likely increased stimulus from the Biden administration. Now, that's good news, at least for short term, but long-term implication could be different. But anyway, that's another message I get. Third is China. China is, of course, very important. There, a 7% growth prospect is slightly lower than most other predictions. Even World Bank, we're talking about 8%, and some even higher. Now, there, the reason and the kind of vulnerability you mentioned is the important one. That is the imbalance between supply and demand. Consumption has been weak side and hasn't been recovered, and that's the key thing that you would like to see. Now, fourth is Korea. I very much appreciate your relatively optimistic view about Korea. 3.6% is one of the highest figures I have seen for Korea. Even the government prediction has something like 3.2%, whereas OECD is talking about 2.8%. So somewhere between 2 to 3% range has been talked about. There, I think the point you made was a very important one, because after all, Korea's recovery and sustained recovery will depend on job creation. That's a very important one. We take note of it, and also I think I might like to add a point there is that not only the quantity of job, the quality of job will be very important, because in the short term, government may be tempted to push for greater fiscal stimulus or relatively short-term jobs or public jobs, whereas more sustainable private sector jobs. So I think that that point needs to be made very clear because that has something to do with the government policy stance down the road. Now, having said that, perhaps a few questions. First of all, you made a very important point about as kind of downside risk for this year. Debt dynamics would be important, especially corporate debt you mentioned. This S&P is the most prominent rating agency. Could you elaborate on this? What sort of areas where you attach this more greatly, different sectors and different industry or corporate segments that you think more vulnerable and need to take more measures in advance? I hope you can.
Absolutely, sure. Okay, so Dr. Jun, that I think that is something that we look at very closely. Clearly, given our job, the way we think about debt risk is mainly a corporate sector issue. Household sector balance sheets in most of the economies we look at. Korea is different, I know, but the US, Europe, even China, household balance sheets are actually in pretty good shape. In the US, they're in fantastic shape, actually. So the old sort of debt problems that we had in the financial crisis 12 years ago are not the debt problems we face today. Then it was very much household borrowing. Now it's corporate sector borrowing. The debt is definitely concentrated in the weak tail of the distribution. So it's in those sectors where we've seen the greatest fall in activity. So travel, accommodation, offline retail. And that's where, if you look at some of our research on what we call fallen angels, these are companies that used to be rated investment grade and have fallen to sub-investment grade. A lot of those fallen angels are in those sectors that have been so much affected by COVID. So really, it's difficult to see things getting too much better for these sectors until the economy genuinely opens up in these areas. And that can only happen when the vaccine is broadly distributed. So that is a 2022 story at best. In some cases, we think for travel globally, it's a 2023 story. So it's going to be a very difficult period for these sectors. But at the same time, while you're going to see these sorts of isolated stresses in some sectors, and the risk of a sort of broad and acute debt crisis we think are very low for a couple of reasons. First, if you look at the rest of the corporate sector, parts of technology, for example, or the financial sector, actually balance sheets are in much better shape than in others, and in fact are in pretty good shape relative to where they've been certainly, for example, before the last financial crisis. So our global financial institutions team is flagging concerns. I mean, we know that NPLs are going to rise. There's been a lot of debt moratorium that's going to weigh on bank balance sheets. But broadly, they're pretty comfortable that the global financial system will come out of this in reasonably good shape. And we're not seeing the vulnerabilities that we saw in previous cycles. And the same is also true for a bunch of other sectors, including technology and industrials. So overall, it's a concentrated problem. And then, of course, we have central banks. If central banks are forced to hike rates quickly, for whatever reason, maybe they're concerned about financial stability, then we could see those credit stresses really emerge. But as far as we can see, central banks are willing to keep rolling this over. And so long as they keep policy rates low and credit spreads low, then we think the risks are minimal. Where I do worry a little bit is weak balance sheets and the effect of growth on the next 2 to 3 years. Because if we want to see export growth continue, firms are going to have to start spending on capital equipment. And if they're worried too much about their balance sheets and less about expansion, we're not going to see that spending. But that's more of a slow drawn out problem than a debt crisis problem.
Okay, thank you very much. Perhaps one quick last question. Time is short. Now, you did also mention something along the lines of trade war. Even though it started when Trump is in office, but you did say that geopolitical competition is just starting. Now this with Biden administration coming on board, it's not going to be relieved from that tension. Now you also talked about RCEP and US likely joining in TPP, and some competition may as well. Now, looking beyond this year, now how do you see? You said China's 5-year economic planning is very important to see how the country will shape up and how that will affect the neighboring states and the world. Also, this year, China will celebrate 100th anniversary of Communist Party founding, and U.S. have new administration. Now, perhaps this may suggest another round of intense competition between two biggest economies, and has important implication for countries as well. So my question to you is that perhaps in 5 years or 10 years, how do you think the balance between two powers will be reshaped, or pretty much as we see them now, or big changes or turnaround you anticipate? How do you see the future prospect of it's not an easy question, but certainly important.
Yeah, let me be quick on this, because I know we're running out of time. But I think, first of all, much will depend on China's dual circulation policy. If China really pushes hard on dual circulation and tries to capture all parts of those supply chains that it is critical to its growth, from semiconductor capital equipment all the way through to cell phones, and every stage within it, I think that is going to be, first of all, intense competition for economies like Japan, Korea, Taiwan, but also the US. And it's going to be tough because there's going to be a lot of policy support behind that push in China. And it's going to, I think, alienate maybe some of its trading partners, depending on how much policy support they push behind it. That's the first issue. How hard is China going to push on those areas? And we think they're going to push pretty hard. And the second one is will the US re-engage with TPP? I think that's the other key issue. We think they will, and we're looking for the Biden administration in the later part of this year to reopen those negotiations and to pull as many countries as it can back into a deep TPP, which stands in contrast to the RCEP. So you're going to have these two competing systems: China, which is going to be trying to capture large parts of the technology supply chain, and the US trying to pull countries into TPP. I think this is going to be the big point of tension. It's not probably going to spill over into a full-blown trade war, but it is going to mean, in economic terms, an intense amount of competition, lower prices, more volume, more choice for consumers, at least in the near term. And I think it's going to be tough to compete with China because it has huge economies of scale that are not easily overcome, even with political risk. So it's going to be a tough 5 to 10 years.
Thank you very much. Now it's time to close. Thank you, Sean, for sharing your great insight with us today. Hope to see you soon in person, perhaps with vaccines.
Thank you, Dr. June. Thank you, everybody, and hope to see everybody in Seoul soon.
Okay, and I would also like to thank all the viewers for joining our webinar today. Thank you very much. Okay, bye now, Sean.
Bye.